everyone, welcome to the Monkey Stock Club. For those who are new at this channel, my name is Monkey B. I love to go out there doing the hard work and finding some nice stocks for you. All you have to do is just watching this video and decided if the following stock could be something for your portfolio. Please feel free to hit the subscribe button below to become part of the Monkey Stock Club family and never miss a video again. All I say here is just my opinion. And as I'm not an investment advisor, please be aware that everything I say here is not an investment advice, as I am just a monkey, as you can see. So stick around and let's discuss the following stock. So today I want to show you a high growth investment opportunity. We will talk about Opera. It's an internet provider, but I will show you on the next slides. So here the following approach, how we will proceed in terms of the high growth investing strategy. So first a score is calculated for the selected share according to a simple point system for each share. The score consists of 6 criteria for which 0 to 3 points are awarded, and in total you can achieve a maximum of 18 points. Then in addition to that, there are some conditions which need to be analyzed. So the growth rate within the last 3 years should be higher than 10%. The turnover of the last 12 months higher than 100 million euro or US dollar. The market capitalization bigger than 300 million euros. And last but not least, I decided if the stock could be in Topscorer and will be added to my watch list, which I will always share here within our community. So as I mentioned, Opera Limited provides web browsers through its channels. This product is includes the Opera browser for Windows, iOS, and Linux, and the headquarters is in Oslo. So first of all, we take a look into the enterprise value related to the sales. And the EV is a measurement or a measure of the value of a company regardless of its financing. So if you divided the enterprise value by sales, you get an important ratio for the estimating of the valuation of fast growing but still or maybe loss-making technology companies. And the ratio refers to an enterprise value at the current point of time. So here you can see also the formula, and as we can take a look here, we calculated 2.4 that this is below 8 points, as you can see here. So we got 3 points. So what else? Here also a screenshot from Yahoo Finance, the enterprise value as well as the revenue. You get all the numbers from the internet, and as I mentioned, I calculated 2.4. So our first 3 points for Opera Limited. Let's proceed. Next one, the gross margin within the last 12 months. Gross margin of round about 57%. We got 1 point as we are smaller than 65% but bigger than or equal 50%. And the gross margin is a percentage of sales that remains with the company after deducting direct product costs or production costs. So here's also the formula behind it, and the gross margin provides a good indicator of the profitability of a business model. The higher the percentage, the more money a company has available for sales, marketing, research, development, and other capitals. So one further point. So we have 4 currently. Coming to the rule of 40 score. The rule of 40 score, it's a simple key figure for assessing the efficiency of a company growth and the quality of its business model. So the ratio calculates as a sum of the sales growth rate and the free cash flow margin. And the higher the value is, the better the business model of the company. And value above 40 are considered as very attractive. So here we have an overall rule of 40 score 123%, as we have an total revenue increase compared to the last 12 months of over 126%, and in cash flow of minus 15 million. So in total as a sum 123. So we will get 3 points as we are above 50%. So the next one, sales growth, trailing 12 months. So the sales growth compares the sales of the last 12 months. That's clear. So we have an 126 increase compared to the last 12 months. Here also a screenshot of the last years, so you can see a very nice growth in terms of the revenue and also in terms of the earnings. And this confirms in addition to that the Opera Limited is a highly growth company. So 3 points. Next one, the debit ratio. The debit ratio is calculated by dividing the sum of the current and non-current liabilities by equity. So the last quarterly figures are used for this calculation. Debit ratio less than 1 indicates low debit, while a debit ratio greater than 2 indicates possible risk for debit. Here we talk about 0.07. Here I did a screenshot also from the total asset, the total equity, as well as other KPIs. So if we then use the ratio, debit ratio of the debit related to the equity, we have a very low debit ratio, and for this figure we get 3 points. The last key figure, the PEG TTM. So the PEG is one of the most important key figure for the assessment of an already profitable growth stock. So it's calculate the ratio of the PE and the profit growth. If the ratio is between 0 and 1, this indicates an undervaluation. So this was also confirmed, or let's say created by Peter Lunch, who said that the PE should equals the profit growth, and this should be 1 then. So the PEG can only be sensible calculated for companies that are already sustainable or sustainably profitable. So as we saw, Opera Limited is already, let's say, within the last years profitable, and they show also a nice growth. And here we have an 0.79, so we will get 3 points, as we are between 0 and 1. And the PE TTM 25%, and the profit growth 32% TTM. So therefore we will get 0.7 and 3 points. Here you can see, in addition to that, as I mentioned, that we also analyze the sales growth within the last years. 2019, 95%, 2018, 32%, and 2017, I didn't get the numbers in the internet, so NA. So, and then finally, as I already mentioned, we got 16 score points for the high growth investing strategy out of 18, so it's a quite nice score range. That is why I selected Opera Limited as a very interesting stock to invest for. Here in summary, all the points, 3 points, 1, 3, 3, 3. So in total overall 16 points. And in addition to that, I also put in the earnings estimation. So the current one was 0.28 EPS, so the earnings per share. And the current estimation for next fiscal year is 0.54, so almost doubled. And if we use this profit growth of around about 100%, multiply with the current EPS of 0.37 to calculate the fair value by Peter Lunch, we will get a fair price of around about $70. So here we have a big leverage or lever of 6 up to 7. So this could be really a very nice opportunity for us to invest for. So that's it. I hope you enjoyed the video. Please always be cautious in investing. Think about your investments. Take your time. Be well prepared and also know all the risk as well as all the chances. And I hope we will see each other again. And yeah, have a nice day. Bye bye.